Hello and welcome to the abbreviated version of the second quarter results. In the second quarter, the portfolio is down about 3%. That compares to the growth blend, which is 70-30 stocks and bonds, which was down about 1%. And the Toronto Stock Exchange was down about 2%. On a year-over-year basis, we're up about 11% versus our target of 8%. So we're still doing well, but we did fall back a bit, basically because the US dollar was very weak. Now this is an abbreviated version, and I'll be going over basics of where we are, what happened, and where we're going from here. But if you have any questions whatsoever, please give me a call. I love talking about this, and I want you to be completely informed about what's happening with your money. So we always look at this, which is the big picture. This tells us whether we should have more or less money in the stock market. And we look at three things: valuation, sentiment, and the economic outlook. Over the last while, we've gotten to fairly expensive stock market, so this has become a question mark. Also, investors, particularly in the US, have become optimistic, so this is a question mark. The economic outlook, on the other hand, is extraordinarily positive. There's no recession in sight, the global economy is doing well, everything is looking good. Now there is a slight distant cloud on the horizon. They've started to raise interest rates, particularly here in Canada for the first time. And somewhere out there, if interest rates get too high, it could have a negative impact on the economy. So given the fact that we have this less positive environment than before, and I've said that as things go up, we would be reducing our exposure to the market to be more conservative. And we did that. We went from the maximum to the normal, which is 70%. In fact, over the last couple of weeks, I even went further and we reduced our exposure to 60% stocks and 40% out of the stock market. I'll be talking about what our choices are and where we position the portfolio. So we reduced our exposure from 100% equities to 70% equities right here in March. I feel really good about the fact that we stayed fully invested throughout this entire period. The balanced people who have a maximum of 70% of the market, they've gone to 50%. So they also reduced their exposure. Since we started reducing our exposure, the stock market in Canada really has done nothing. In fact, it's gone down. So it's a good thing we did reduce our exposure. Recently, we did reduce our exposure by another 10%. This is the shift we've made in the last while. We bought more Europe, this time especially Germany. German economy is doing well, Europe is doing well. We switched from US banks into Canadian banks. We did buy an alternative investment. This is very important. I'll be talking about that shortly. We reduced our US bonds, bought Canadian bonds, and bought preferred shares. Generally, we reduced stocks versus bonds, and we now have more Canadian and Euro investments and less US dollar investments. This is a new investment of ours. It is HGC's arbitrage fund called an alternate investment. What happens here is that this fund invests in takeovers. So let me give you an example. Let's say IBM comes in and offers $10 a share to BlackBerry. Well, the shares go up immediately to, let's say, $9.75. BlackBerry shares don't go fully to $10 because you have to wait 3 or 4 months for your money. and BlackBerry has to have a meeting to approve the merger. So there's so many people that sell their stock at $9.75 because they don't want to wait for the extra 25 cents. They want to go out and buy another technology stock. Well, this company, our investment here, they do buy the stock at $9.75 and they get their $10 in a few months, and they make, let's say, 3% by doing that. Occasionally they get lucky and another company makes a higher offer. So instead of getting $10, they get, let's say, $11. So this kind of takeover deal happens very often in North America. And this company that we're investing with looks at all those deals. And these are the results. You know, they've made an average compounded rate of return in the last 4 years, very consistently, up and up and up. Average rate of return is about 14%. Now, the only two losses they've had, a small loss here and a small loss here. So they've only had 2 losing months in the last 4 years. And we can see here in 2015, when the Canadian stock market was down, they were up. So this is not a risk-free investment at all, but the consistency is extraordinarily high. And I think this is a good place to have money when we're not in the stock market. So if you have any questions about this, please give me a call. So the results in our portfolio over the last while have been extremely affected by the Canadian dollar going up dramatically against the US dollar. Surprisingly, it happened when oil prices were falling. Normally that puts the Canadian dollar down. Their interest rates were going up. Normally that makes our dollar go down. The NAFTA negotiations are coming up. We had a crashing real estate market in Southern Ontario. But what happened was it surprised everybody that the Canadian dollar went up. And our US dollar investments were impacted. Now, I think that the Canadian dollar likely has gone too far, too fast. There's not one Canadian bank that has a projection of the Canadian dollar to be over 78 cents by the end of the year. And right now it's at 80. So that means it could go down a couple cents or about 3%. So anything we have in US dollars, if it did go back like that, would be aided by about 3%. Now, this is what's happened in key markets. The US market gave a rate of return in the quarter, including, this is in Canadian dollars, was basically flat. The Canadian market in Canadian dollars was down 2%, so it did very poorly. So the fact that we had money in the US market, there was no shelter to be in the Canadian stock market. And the bond market gave about a 1% rate of return. So when the Canadian dollar was going up from its low at around 74 cents early in June to where it is now at 80, in the fixed income investments, the preferred shares that we own are doing very well. They go up when the interest rates go up. Other bonds, the Canadian bond index went down about 3%. We own short-term bonds, they went down less. And US bonds, because of the currency, did extremely poorly. Now this is even beyond the end of the month. This is to the last couple days. Up until the end of the month, these bonds were down about 4%. Altura is drilling a new well in their big discovery just south of Edmonton in the Leduc area. This is a very exciting play, and it could really dramatically change the valuation of the company. So they've drilled 2 successful wells on this property, and it's looking extremely good. So here's the portfolio as it stands right now. We have quite a bit of money in the Canadian Bank ETF, Altura. Now, some people don't have Altura. If you don't have Altura, that money goes into more of the Canadian banks. The Internet ETF is doing well. We have two general funds. One is Momentum in the US. The other is the NASDAQ, which is a technology-heavy index, the best performing index in the world. Quite a bit in these two US indexes. And we have Europe and Germany. Quite a bit of money there. So in our stocks, we have about 40% in Canada, US dollars, I'm sorry, about 28% in Canada, about 32% in euros. As far as the industries we're heavily involved in, financials, mainly banks, we have about 33% of the portfolio. That's in the stock area of the portfolio, 33%. And technology, we have about 22%. So those are the things we're emphasizing at the moment. As far as the overall portfolio is concerned, on a hypothetical $1 million portfolio, the growth investors have 600,000 or 60% in stocks. We have about 200,000 in fixed income, i.e. bonds, bond ETFs, about 100,000 or 10% of the general portfolio in preferred shares, and about 10% in the alternate investment, that merger arbitrage alternate investment. As far as currencies, including bonds and stocks, we're about a third in US dollars, about half in Canada, about 20% in the European currencies. So that's it for the abbreviated version of our meeting. If you have any questions whatsoever, please give me a call. I love talking about this stuff, and I want you to be fully informed and comfortable with what we're doing. You know, the savers nowadays are dealt a really difficult situation. Interest rates are microscopically low, and the stock market is relatively high. And yet, you know, you just can't leave your money in GICs at 1% if you want to make a decent rate of return. So we have to take risks. My objective is to reduce risk as much as possible, take advantage of things when they're safer, have less in the markets when it's more risky, and by doing so, earn a decent rate of return with as little risk as possible. Thanks very much and have a great summer.